How can you build audit-ready finance teams to protect you when invalid deductions come your way? A partner from a global accounting firm has advice for you next on the Savvy Supplier. Welcome into the Savvy Supplier, where we save you time and money. I'm Al Frank. As always, Boyd Everett, the CEO of HRG, is here. And we're joined today by a great special guest, Kevin Stewart, his partner at Crowe, one of the top accounting and consulting firms in the world, which is very impressive. And Kevin, you have a wealth of knowledge about a lot of different things, including knowledge about Boyd Everett, I'm sure. Maybe you share a story or two as we go.
We will. I've known Boyd for over 20 years at this point, or close to 20 years at this point. So a lot of good friendship, a lot of good working knowledge, and a lot of respect there on hopefully both accounts, but definitely me for him.
Boyd, tell us a little bit about Kevin and what you've seen from him over the years.
Yeah, we share a love for history to begin with. Traveled in the same circle of friends, and we quickly found that we had a lot in common. I think when we met, Kevin was at Walmart working there. And so occasionally we would talk some shop and things that I was seeing, from HRG's perspective. And every once in a while we'd say, oh, yeah, I know that person. So Walmart's a large company, as everyone knows. So whenever somebody comes up on our shared radar, as it were, it was always made for interesting conversations.
Sounds good. Well, Kevin, let's start with this. What would you say is the first step a finance team needs to take to begin managing deductions effectively?
It's a good question, but I would probably step back from that and I would say managing their own function effectively, right? And deductions is a piece of that. But a lot of it comes down to is managing your own shop, your processes, having good information. But when you boil it all down, it's about data, right? And so it's the costs that are coming in to make up your inventory. It's the selling price by which you're pricing it. But all along the way, if you don't have the right processes and the order and the right people in place and the right talent, it becomes challenging. So it really is about getting your house in order and having the right structure and processes. So much of the work that I do with accounting and finance teams and companies that are in this, we'll call it growth phase or this change phase, and that could be getting into a significant buyer like a Walmart or a significant buyer like any other large retailer. But it's being ready for those changes and being ready to step into the big leagues, whatever that big league is, with your own processes. And so where we step in a lot, at least my team, is really specifically with accounting and finance teams and helping them map out where they are. So very clearly understanding, assessing, this is where we stand today, not much different from how Harvest steps in specific to deductions. Here's where we are today. Here's where very good or benchmark type companies are. This is where we're heading. So how do we get from where we are today to where we need to be? It's really focused on processes and systems and people. And if you can do that, then really deductions is just a piece of that. And it's just a natural part of your DNA and managing your own business.
And that's excellent. What are some common accounting pitfalls or mistakes that you've seen along the way that kind of take a big toll on retail suppliers?
It's the lack of understanding of your real costs. So if Boyd and I were having this conversation a few days ago, and it's really related to we've gotten brought in a lot of times after a transaction or after an event, and their clients are saying our costs do not make sense to us, right? What we thought we had in margins, we don't actually have in margins. So we're not making as much money as we thought we could be or should be. And so many times when we step in, we see where there's data issues kind of flowing through, or they're not capturing certain costs, whether it be tariffs or shipping or discounts or any number of things that can impact that specific cost or that standard costing. And so in that, what we found at times is companies think they're making a significant amount of money, or maybe they think their highest margin is on a certain product. But when you boil it all down, at times, not often, but at times, they're actually losing money. So they're selling at a loss on those specific items. And it's because they haven't had the right disciplines, or something's happened in the system that they weren't aware of or caught. And so it's going back in and helping them that adjust that. That could be just data flow. It could be some performance improvement issues. It could be some other things as well. But the big thing is really understanding where your costs are.
Talk about tariffs right now. A very challenging time for accounting firms trying to handle what to do about tariffs and accounting for that. Any advice you might have for retail suppliers?
We have experts on hand to manage that can go in and look at what those duties are coming in. They can look at what the duties should be. kind of assess that. But I think when you look at those types of issues, in the CFOs that I've worked for personally and direct with, it's everyone hates surprises. Especially CFOs hate surprises maybe more than anybody else because it becomes about blocking and tackling. What did we miss? What risk did we not consider? And I believe with the tariffs specifically and the current administration and what they're doing, whether we agree with it or not, I think the struggle is the uncertainty of, are they actually 10% tariffs? Are they not? What are the goods on? What are the exceptions? What was the negotiation? So really, the advice would be you have to roll with the flow because I think we're living in an age of uncertainty as it comes to the tariffs. But I think once they're announced, you have to start planning for when those shipments are going to be impacted. Is that 3 months from now, 6 months from now, 9 months from now? And start baking in those considerations as you're negotiating with who you're selling to, because it has to be a baked in cost. Somebody has to pay that. Somebody has to pay that tariff, and unfortunately, at the end of the day, it's going to be the consumer.
Well, Kevin, think downstream of tariffs, right? So not just at that point, but communicating price increases. Some things can go wrong in that you don't notify your customer in time, but then they change. In retailing, anytime there's a price move, there's always room for error. And so maybe from a standpoint of accruals, maybe the accruals are a little larger than before. I don't know. What do you think downstream of tariffs? In other words, from a cost structure, total cost to serve, what would you see from that standpoint? Not just understanding what duties do we need to pay, but how is that going to impact our portfolio of items that we're selling?
It's a good question that I don't know that there's a clear answer to, at least
Right.
from my perspective. It's just a little bit outside of my expertise. I'll admit that, but it becomes, where are you focusing what you're selling, right? Because there may be a change of like, that's not a pricing strategy that fits into what we want to do. And so that leads to manufacturing. Do we manufacture it in this country? Do we move that manufacturing? And that's a big decision. That's a big decision beyond really just basic pricing. But when it comes to pricing itself and downstream, I think we scrap tariffs here, honestly, because it's completely outside. I'm talking theory as far as my own opinion, more so than expertise.
When you're talking about systems and communication with your customers, implementing those price changes, knowing that they went into effect properly, your invoices are good, your allowances are mapped correctly, right? Because I think you and I have talked about this before, where Walmart will ask for a warehouse allowance, but you end up sending them a volume allowance. Functionally, it's the same, but it's coded differently. So Walmart said, we didn't ask for the volume allowance, thank you, but here's our warehouse allowance, and then they deduct. And so maybe it's a matter of having some internal controls where you're auditing those, when you're implementing price changes. I don't know if you can speak to that at all.
Well, I think it's speaking to, and what we're getting into is more revenue recognition, honestly, when it
Okay.
comes down to it. And so within revenue recognition, are your contract terms in alignment with how you're recognizing revenue? So on the other side of that, if there's room for negotiation post contract, it's just making sure that those are tracked appropriately within your systems. So specifically, and as we have things like tariffs that are going on and how that impacts pricing, I'm an accountant, right? So I love straightforward things.
Yeah, right.
So in negotiating into good faith, if you allow yourselves a lot of room for adjustment, there becomes complexity, which tariffs are complex to a degree because there's uncertainty of how that's happening. But it's whatever you agree to with your retailer that you're selling into, it has to be trackable in an easy way. If it's a tariff, if it's a fee that allows for adjusting of pricing, I would say whatever you set up and agree to, you need to be able to make it trackable relatively easily so that you yourself can go back in and say, this is what we agreed to, this is the pricing, this is the reason for the adjustment, so that you can almost provide an audit trail when those third-party auditors or the internal auditors or internal, pricing teams or whoever is kind of doing that work to assess if the vendor is in alignment or the vendor is in alignment. But in the same way, whatever you agree to needs to be trackable. Because it's not trackable, then you're completely at the discretion of whoever you're selling to. And that's just not a good negotiating position.
Well, what about from the perspective of how those teams, sales, finance, credit collections, they interact with each other? Because when you have something with like tariffs where there's a lot of conversation about who's going to pay for what, and what if, finance wants to keep things close to the vest, sales, they want to be a good partner with the customer. And so you could easily see how there's some friction internally, right? Have you seen some cases where there's not tight alignment or lack of alignment?
Probably more frequently than I like, but the to the extent that a team can be a team, right, and have a strategy understanding of this is how we're approaching this specific, retailer in this specific instance. Because every retailer has a little bit of a different culture and how they're approaching their own vendors. Some are aggressive, some are less aggressive, some are cooperative. But you really need to match up your approach to the culture of whoever you're selling into. So if the finance team, the sales team, the whoever team, right, the buyers within that inventory kind of funneling in that the inventory supplies, if you're not on the same page, it's easy. We talk about families a lot, you and I, Boyd. If mom and dad are not on the same page, then it's easy to, allow Johnny to have ice cream at 10 o'clock at night because dad's distracted with other things when mom already said no. And so when you're divided, it's much easier to be manipulated or to lose, however you want to define as losing. So I would strongly suggest that teams are on the same page. And so as you're engaging, you're agreeing that this is the pricing difference or this is the pricing variance. These are this is what we're allowing, this is what we're granting. And it is making sure that that sales team is kind of in line. I do, and a lot of organizations are more sales focused, and it makes sense because they're driving revenue, but there's risk associated with that. But as long as everyone is in alignment with the risk being taken, that there's not a rogue salesperson or a rogue finance person, that if you're on the same page, it does make life easier when you get into those audit sessions, 6 months past the cycle, a year past the cycle. If everyone is in alignment, then it's much easier to defend. And even taking a step beyond that, if on the front end that there's some proactive things that you can be doing, this change happened, communicating with whoever your contact is at the client, getting alignment, getting acknowledgement of that. So almost like a confirmation of this was the change, I see the change, it's being applied in this specific way, I agree to it, that you can hang your hat on the back end of it. That 5-minute effort may save tens of thousands, hundreds of thousands, you know, the pain and suffering that comes from a post audit.
Kevin, speaking of change, are there any trends right now that you're seeing? Boyd and I have talked in this podcast about an increase in online product returns and a large increase in excessive defectives. Are you seeing any trends or changes that change the way suppliers need to manage deductions?
No, it's if I think about an accounting and finance team, we should be the lighthouse, on in the ocean. We should not change dramatically. We should be the one that's centered because our world really isn't changing necessarily. Data is still flowing in, deductions are still flowing in, sales agreements are still flowing in or out. The team is operating. Really, the accounting and finance team should be stable and grounded very clearly in processes. And the other teams should see that. And so they should operate in that way. So as I'm engaging and interacting with CFOs, you let in with this as being audit ready, right? And I think really what that means is when I think about that, it's not being audit ready, it's being change ready. That change could be you're doing so well, somebody wants to invest in you. Well, what do they need? They need data and information. How quickly can you turn that around? Does it take days? Does it take weeks? Does it take months? Do you have to hire somebody in like me, which I'd be happy to do? Do you bring somebody in like me to get clarity from your data so you can present it to somebody? But really, at the end of the day, it is about having such a structure that we're providing the right information for decision makers, the sales team, sales leadership, executive leadership, to be able to make educated, qualified decisions based on the best data that we have. So whatever change is going on, whether it be economic issues of what the current administration is making or future administrations are making, whether it be tax issues, whether it be a supplier goes bankrupt, whether it be any number of things, the accounting and finance team should have their house in order more so than anyone else in an organization so that they can allow the best decisions to be made based on the information we have. And sometimes we have to be the bearer of bad news. You make this decision, this is the impact. You think you're going to make this much revenue. You're not because this is the accounting guidance. But really, we're educating all along the way.
Well, I can tell you're a voice of reason and very stable voice, got a lot of experience, obviously. Are you, as you consult with different suppliers, are you seeing a lot of panic out there?
I don't see panic. I see concern, right? It does come down. It seems we having a little bit more clarity in the last few months, but at the same time, I think it's just concern. And you see that in the market and that companies are holding back on, you see it in private equity. I'll put it that way. Private equity doesn't seem to be transacting as much as maybe they would have 3 years ago. Different administration, different party in the administration, a different approach, but at least they had a bit of certainty of what was going on. So I think what happens is the lack of certainty in the playing field or the rules of the game, it does make it hard to make decisions of, we'll call them life changing decisions or business changing decisions when you don't really know what the impact is going to be from a tax perspective or from a cost perspective. So I think it really boils down to, I think there's just legitimate concern of what's going to change 2 months from now, 3 months from now, 6 months from now, and how does that impact my own pricing, my own profitability. So why don't I hold back and see if that battlefield clears a little bit so I know what my next move needs to be.
Earlier, you talked a little bit about documentation, that paper trail that's needed. What do you see as kind of a missing element with that, that suppliers aren't always careful to keep those records to be able to dispute invalid deductions successfully?
I think what it comes down to is it's not deemed as important. And what's important, I believe, to a lot of companies, we need to sell. And it is important. I mean, if you're not selling, you're not generating revenue to come in. But at the same time, you have to protect on the backside of, all right, well, we sold, but truly, what is our free cash flow there that we can actually do something with? And so I don't believe it's intentional. But what we see a lot, because in my specific area and within Crowe, a lot, we're seeing companies in transition. They're transitioning from a $25 million company to a $50 million company or a $100 million company to a $300 million company. So we're dealing with companies that are constantly in this transition and frankly, a pretty significant growth mode. But when you go from a $25 million business to a $100 million business, that's a tectonic shift in the way that you operate. You're moving from being a mom and pop ish type company, a successful mom and pop type company, to really an organization. Then you have to have different layers of support. You have to have a different level of talent and expertise as it comes to finance function, building teams. Your CEO and your founder is becoming more of a leader and executive versus a doer themselves. So they're really having to develop an organization that maybe they've never done before. They're having tremendous success. They've made more cash than they've ever seen before. But building that team to have the extended life and growth is not quite there. When I left Walmart, I went to work for Charming Charlie. And Charming Charlie at the time was a very successful growing retailer. They're relatively new. I think they're about 7 years into it. And I'll call them an advanced startup. They had just gotten some private equity money. They had grown to about 500 million in revenues. But that growth pattern of really the last 3 to 5 years before I stepped into that was when they experienced the huge growth. It took them 20, 21, 22 days to close the books each month, private company. It was profitability. They were struggling a little bit on kind of year to year growth, but as they were building new stores and new stores and new stores, it was masking that a little bit. Processes were not documented well. In visiting with our auditor, he shared it was the closest thing to unaudible he'd seen in his career. And so the back office function truly was treated as a cost center versus as a partner. So when I stepped in, and I had a boss I was reporting to, stepped in shortly after I did, about a month after I did. But our task was really about, how do we standardize? How do we make this better? How do we partner? And the way that we did that, and there's a lot of talent across Charming Charlie, and that are now at different other retailers who are having very successful careers. But at the time, we'll call it the land of misfits a little bit, as we're trying to come together and restore and build something for the future. For me, what that meant was I wanted to very, very clearly partner with the organization. Yeah, it's taken us 21 days to close, but the culture was the previous controller and the previous assistant controller were all about, every single penny. And they were looking at so much detail that they weren't looking at the big picture to say, a bus full of deductions could be flying through this gap because they were so focused on the penny that they weren't seeing the big picture necessarily. So when I stepped into it, and I was the assistant controller with that. In some companies, that's a peon. In this company, there was some level of influence in that. But I met every single party that we interacted with within the accounting function. Our payables, we were struggling to pay the bills. We were getting frequent calls. We were being cut off. Our vendors weren't loving us. We'll say, whether we had to be a store level or whether it be our vendors themselves. So our processes were not documented well, and it was impacting the business. And it truly nearly every day, I was getting a call as the assistant controller over the AP function about, we need this paid, or we're shutting off your electricity, or whatever it is. Honestly, silly stuff, because we didn't have our debits and credits and all in order. They just weren't in order. But in meeting with everyone within the function that I considered a client of the accounting team, and building that relationship and building collaboration, after doing that for 3 weeks, we came back and it's like, all right, here's how we're going to work. Here's how the team is going to work. Here's how the team is going to engage with you. Here's the responsibilities of the team. And then separately, here's how we're closing the books. And I'm not asking you, I'm telling you, this is how we're closing the books. I'm reaching out to you 3 days before the end of the month. This is your role. This is the expectations. If you don't have it in, we'll get it in next month. And so this is how we're going to operate. And so really even within a month, we went from 21 days to 5 days. And then it went from 5 days to 3 days. And then it stayed within that 3 days to 5 day window from just an execution reporting up to the CFO and having everything done. So I share that story a little bit because it was a $500 million, it was a retailer, right? I thought they were a good guy at the time, right? But the good guy of a retailer, we're selling to our market, doing whatever. But to me, what that showed me and what that has led to how I consult and advise my clients now, it's making a choice, right? We're going to do things different. I understand every company is a little bit different. Every culture is a little bit different. But from what I could control, I was changing the culture of my team and how we were supporting the organization. And we were going to be that lighthouse, that light tower in a land of uncertainty and chaos for the rest of the organization. And we built respect. The rest of the organization began to have more respect for us. We became a respected partner. Our auditors had a little bit of a better life. We made that engagement not a horrible engagement for their team. It wasn't perfect by any means, but in about 14 months, it went from absolute chaos, unpaid bills, unreconciled accounts, closing the books in 21 days, to a systematic closing the books in 3 to 5 days, having good information, having good reports, not everyone hating life, and it actually being a decent job. So all that to be shared is accounting and finance team can drive the culture of accountability, discipline, and responsibility. And I believe that's critical, right? And if a CFO is out there and is struggling, or if they're concerned or whatever else, I believe there is value. There is true respect for somebody raising their hand. It's like, we need more. We need to invest here. We need some short-term help. Our talent level is good, but where we were and where we are now is very different. How we build a system. And going back to Charming Charlie, at the time, the desire was to eventually going public, considering that didn't exactly work out. When I was there, I was having, and I've shared this many times, it was like I was looking in the past to repair all the sins of the past. I was trying to stabilize today to make sure that we're closing our books and getting everything done right. And then separately, I'm just looking out to the future and envisioning what do we need to be the organization we need to be an IPO. And at the time, we had 20 people within, AP, payroll, accounting, and some cash stuff. But I didn't believe we needed 40 people or 60 people to be a billion-dollar organization, accounting and finance team. We just had to have the right processes and procedures and talent in place to be able to support a growing, fast, internationally expanding organization. And so as I'm advising clients today, I have that experience in mind. I have that stress in mind. I had a huge amount of stress. My blood pressure was a little high. And so, but I think about that often, and the pressure I was feeling in that specific moment, the fear for my job, the fear for my team, wanting to build something to be proud of. And so as I'm advising now, I'm truly thinking in that moment. And so again, whether it's a $25 million organization, 500 million, or a billion plus, the playbook is the same. Getting your team in order, looking to the future, building what you need. And sometimes that requires a little bit of support of me, a little support of Crowe. And that could be performance improvement work of really driving how do we get better inventory management? How do we get better turns? How do we get better profitability? How do we close the books faster? How do we do it with less people? That's where we step in, is that in those moments of it just seems like all is lost. And so the sell on that really is the CFO and the controller's responsibility is to assess the risk. They're sitting in a position where they can see a lot of things across the table, across the company. And they should be seeing risks as it relates to deductions. They should be seeing risks as it relates to the pricing strategy. They should be seeing risks as it relates to tariffs. And if they're not, then maybe they're too busy, right? And maybe they need to step back. They need a little bit of assistance. They need a steroid injection of some accounting advisory of a firm like Crowe to come in and really get them, 2 months of work and assessment and cleanup and partnering side by side with them. may get them to the point of being free them up enough to truly serve in the role that they need to serve in, which is about risk management versus just debits and credits. Debits and credits aren't hard. It's just booking entries, right? But it's based on the data that you have, with the systems that you have, with the people that you have. And if any one of those things is off, it is so much more to fix something in the future than it is to get it right now. That $100,000 you may spend today to get it right could be $1 million 3 years from now to go back in and unravel the spaghetti mess of data and crap to then fix and make it right.
And just to piggyback on what Kevin's saying, on the supplier side, you're just talking about the importance of having good systems and processes. One of our clients was a spinoff of a larger supplier. And when those typically happen, and Kevin and I have talked about this before, you don't get the A team, right? They're getting rid of middle management people that they don't want. And I remember going to their AP, which was about 1,000 miles away from where the main office was, where you had the sales team, right? So you have the credit collections team out in a different city. And I remember going there and we're trying to perform an audit, and we discovered that they didn't implement cash application for SAP because they didn't trust it. And so we dug into it. They were applying deductions that were repaid against unpaid invoices.
Wow.
Yeah. So Kevin, I think you can appreciate how wild that is, right? That was the Wild West.
Sure.
Right. And after a while, my team just got, could we fire this client? That was because we didn't know which way was up. So anyway,
Sure.
so it happens on both sides, and and some of the stuff that's going on out there, it's incredible. And that particular company was owned by a VC, and I think they probably were shuddering once they started to realize what they got.
Yeah, and with systems, I mean, it is challenging when I was at Charming Charlie, it was, we had an Oracle implementation, but there wasn't a match of the application of wire payments to way to match that into, the specific invoices, which was one of the immediate issues that we had to remediate in my first 3 months there. And that's simple. Cash application should be simple, but when you're not putting a system in right or using it to its full capability, it creates so many manual processes, which creates so much opportunity for error. Working with another company, right, there was a system update. Job A was supposed to run before job B, but when the system update ran, it actually conversed those, and job B was running before job A, which was impacting the value of the inventory that was going through. And it was kind of a cross-dock thing where there should be no margin added to it. There's no cost added to it. But because of that update, those jobs got reversed. It was adding some complexity to it that shouldn't be there. But it took a solid 2 months of part-time work at digging in to really understand this is what happened and this is when it happened, and then flipping that back, and then it all kind of worked out. But it was not a cheap fix necessarily, all because of a simple update that didn't get kind of processed correctly or validated correctly kind of at the end of it. So systems are great unless they're not utilized fully, or you don't trust them, or separately, there's something happens in that process that isn't validated.
Well, Kevin, thank you so much. Just great advice, a lot of key insights for us to all chew on. Thank you so much for joining us.
Absolutely. Thank you so much. I appreciate it.
Well, to wrap up things, I want to mention that right now, HRG is offering a free tariffs risk analysis to help suppliers with insights on these three things: identifying risk exposure, assessing financial impact of tariffs, and suggesting mitigation strategies. So to get your free tariffs risk analysis, contact HRG at hrg-audit.com. Just one more way that HRG can save you time and money. HRG, wiser decisions, fewer deductions. See you next time on the Savvy Supplier.